In early 2026, systematic long-short equity managers suffered their worst drawdown in 3 months, losing 2.8% in just 10 trading days. This wasn't a typical AI bubble correction. Let's look at the actual scorecard from Principal Global Multi-Strategy Fund for the first quarter of 2026. Macro and CTA strategies gained 1.56%, the only significant positive. Relative value lost 0.54%, event-driven lost 0.78%, credit lost 0.44%, equity market neutral fell 2.2%, and equity hedge dropped 1.48%. The HFRX Global Hedge Fund Index was down 0.57%, while the S&P 500 fell 4.33%. The standout is equity market neutral, a strategy designed to be beta neutral, yet it lost the most. Why? Because these funds use similar factors, risk models, and prime brokerage structures. When volatility spikes, their selling is synchronized. UBS's February observation is telling. In systematic long-short strategies, the largest alpha contributors were mid-term momentum, long crowding, crowding momentum, and short concentration. Mid-frequency models suffered the most because all crowding signals were dragging them down. In plain English, crowding itself becomes a signal, and everyone reads that signal at the same time. This is the structural flaw of market-neutral strategies in an AI-driven world. To understand why signals converge, consider this model. Each fund's signal S_I is a function f of the same data d, plus some idiosyncratic noise epsilon_I. When all funds use similar architectures and data, the variance of the shared component f, d, dominates, and the correlation between any two signals approaches 1. They are not independent, they are fitting the same noise structure. Why are signals so similar? First, shared training data. Hundreds of funds subscribe to the same satellite images, web scrapes, and NLP sentiment from earnings calls. Feeding similar transformers yields similar factors. Second, performative erosion. AI-driven development actively changes price dynamics, so alpha burns faster than in human discretionary times. Third, red queen competition. Managers must constantly increase compute just to stay in place, while industry-wide alpha trends to zero. Citadel's Quant head calls this the AI market paradox. Speed doesn't improve outcomes, it compresses the window for everyone to make the same mistake. April 2026 provided a live experiment. Discretionary diversified equity gained 7%, industry diversified equity 6.8%, and Asian equity long-short 9%. Multi-strategy added 1.6%, equity market neutral 1.4%, global macro 1%, but quant equity only 0.9%. The gap between discretionary and quant was over 6.1 percentage points, the largest single-month gap in recent memory. This isn't classic signal decay, it's structural model convergence. Signals are not discovered later by imitators, they are generated simultaneously by many funds on the same day for the same assets. This bar chart shows the stark contrast. Discretionary strategies outperformed quant by a wide margin, with the gap exceeding 6 percentage points. This is not a one-off, it reflects the structural disadvantage of quant strategies when signals are crowded. The synchronization hasn't gone unnoticed. In July 2026, Bank of England Deputy Governor Sarah Breeden publicly discussed regulatory kill switches for autonomous trading agents. IOSCO expanded its AI toolkit the same month. Regulators implicitly admit that post-trade oversight can't contain machine speed herding. And just a week after Breeden's speech, quant funds experienced a 3.1% drawdown in 5 trading days, while the S&P 500 fell only 0.43%. The forced liquidation of global momentum books is a real-time validation of signal convergence. AI has industrialized p-hacking. At a 5% significance level, testing 100 independent factors yields about 5 false positives by chance. But AI can test millions of combinations in seconds. With 10 million tests, you expect 500,000 false positives, patterns that look amazing but are pure noise. This is why high in-sample performance is not evidence of robustness. Acadian Asset Management warns that financial markets have low signal-to-noise and relatively scarce training data, so blindly released ML algorithms are prone to overfitting. Defensive frameworks are mature. The deflated Sharpe ratio adjusts Sharpe for the number of tests. Benjamini-Hochberg FDR control reduces feature sets by 50 to 80%. Nested cross-validation with true out-of-sample windows is essential, and models must show positive alpha across different regimes: bull, bear, high volatility, low volatility, rising rates, falling rates. Stock Alpha puts it succinctly: high in-sample performance is not evidence of robustness, because overfitting and data leakage inflate backtest metrics. Even if your model is not overfit, your peers are doing the same trade at the same time. This is the industry's collective problem. Individual rigor cannot save the industry from homogenization. The key risk is not your model's alpha, but the correlation of your trades with others. So, what does the homogenization of US equity quant tell us? AI hasn't eliminated overfitting, it has industrialized it. When a significant portion of volume is driven by similar models, individual overfitting becomes industry synchronization, which becomes stress resonance, which becomes liquidity evaporation. The Bank for International Settlements calls this the fragile nature of liquidity. It tends to dry up suddenly in stress because everyone is trying to do the same thing at the same time. In the quant world, the most dangerous sentence is not "my model is overfit," but "my model is different from others," because when volatility spikes, you'll find that everyone trained differently, but sells the same. AI hasn't made markets more efficient, it has made them more alike. And when the market becomes a mirror, it reflects not prices, but our collective fragility. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.